Hi, welcome back to Joe Blogs. In today's episode, I want to talk about the United Kingdom. In 2022, the UK was officially the fifth largest economy in the world. However, it is now facing some serious problems. Alongside most other economies in the world, the UK has been suffering from high levels of inflation over the last couple of years. And in order to tackle that high inflation, the Bank of England has been raising interest rates over the last 12 months or so. However, unlike the USA and most other economies, inflation is refusing to come back down. And the most recent figures for May 2023 show that inflation is running at 8.7%, which is the third highest in the G20. And as a direct result, the Bank of England recently introduced another 50 basis point increase in interest rates. The United Kingdom is an island and is a net importer, but in addition to the general factors that every other country in the world is facing, the UK has also been going through a transition because as a result of Brexit, it decided to leave the free trade agreement with the rest of Europe. So in today's video, I'll have a quick recap as to what Brexit actually means for the UK. We'll have a look at the current rates of inflation and dig down into details such as food inflation. We'll have a look at what's been going on with interest rates. We'll talk about GDP and have a look at whether or not the UK is actually in recession. We'll look at the UK's balance of trade, its current account, how much cash it's actually carrying at the moment, what's been happening to the British pound, what's going on in the housing market, and then finally today I'll wrap up with my summary as to what I think is likely to happen for the UK economy over the course of the next 3 to 6 months. This chart shows the movement in the rate of inflation in the UK over the last 12 months. And if you look at the scale on the right-hand side here, you can see that it actually starts at 8.5% and goes up to 11.5%. And what this chart shows is that in June 2022, inflation was running at 9.4%. There was then an increase over the next 4 months, and inflation peaked at 11.1% in October 2022. The rate of inflation started to come back down in November, December and January when it got down to 10.1%. However, in February there was a surprise increase in inflation back up to 10.4%. It then came down to 10.1% in March, dropped to 8.7% in April, which was seen as being a really positive sign. We saw the biggest reduction in any single month. However, the figures for May show that inflation has stayed at 8.7%, and this was a real surprise to both economists and the Bank of England. And to put the UK's current rate of inflation into perspective, this chart shows inflation for the G20, which are the largest 20 economies in the world. And you can see that the only two countries with a higher rate of inflation than the United Kingdom are Argentina, which has a current rate of 114%, which is obviously off the scale. And if you want to know what's going on in Argentina, check out the recent videos that I posted. And Turkey, where inflation is running just under 40%. And again, if you want to know what's happening with Turkey, check out the videos that I've been posting. So when you look at the rate of 8.7% for the United Kingdom compared with the rest of these developed economies, it's much higher. But the other problem is the trend. As we've talked about, the rate of inflation has remained static in May, which was a surprise to the markets. However, when you look at most of the other countries, we are seeing month-on-month declines in inflation as a result of the fact that they've been increasing interest rates, and that's starting to feed through into spending and bringing prices back down. And if we expand the chart out to show what's been happening over the last 10 years, you can start to get an understanding as to why the current rates of inflation are a real problem in the UK. The target rate of inflation set by the Bank of England is 2%. And you can see that between 2013 and 2021, the rate of inflation moved around between 0 and 3%, so broadly in line with the target level. However, over the course of the last 18 months, inflation has risen dramatically and is now significantly above that target rate. Now, this chart shows the movement in food prices over the last 12 months. So you can see that 12 months ago, food prices were rising by 9.8%, which was broadly in line with the level of inflation at that time. However, since that time, food prices have been increasing by double digits, and the rate of price increases was rising month on month up to the peak of 19.1% in March. That rate has come down slightly over the last couple of months, but in May 2023, food inflation was 18.3%. And the reason that food prices are rising much higher than general prices are twofold. Firstly, the United Kingdom is an island which has a limited amount of land and therefore has to import a variety of different food products. And as I'm sure you'll be aware if you follow the channel, the price of food in the international markets has risen over the last 18 months, and that's feeding through and putting pressure on UK prices. But the other major factor that the UK is facing is Brexit. The UK benefited from zero tax trade with the rest of the European Union. So that meant that when it was importing food from countries such as Spain, France and Italy, there was no tax to pay. However, since Brexit, everything has changed and the UK is now having to pay import duties and tax on that food. And that's feeding through into higher prices for consumers. And as we've discussed in previous videos, the main problem with food inflation is that it's indiscriminate. It impacts on everybody, whether you're rich or poor. But it has a disproportionate impact on poor people because they're spending a much higher percentage of their income on food. Now, the UK is a relatively wealthy country. However, 1 in 6 people are classified as living in a low-income household, which means that they're spending a large portion of their monthly income on housing costs and food. So even though the UK is a developed economy, there are a lot of people that are living at or below the breadline and are struggling to be able to put food on the table for their families. This chart shows the movement in energy prices over the last 12 months. And the reason that I wanted to highlight this is that energy costs have become a major problem in the UK. Despite the fact that the UK has its own oil and gas fields, it is still a net importer of energy products. Unlike the USA, the United Kingdom decided that it didn't want to utilise oil and gas that could be released by fracking, and as a result of that, the vast majority of the UK's oil and gas is produced by offshore fields. And this chart really highlights why a lot of families in the UK are currently struggling. If we look back to June 2022, energy prices were increasing by 57.3%. And in virtually every one of the following 8 months, prices continued to rise by around 50%. Now, the rate of increase has started to reduce over the last few months, and in May 2023, the price increase was recorded at 8.4%, which is actually below general inflation of 8.7% in the month. But the problem that this graph highlights is that over the course of the last 12 months, there has been an enormous increase in energy prices, and energy prices are a staple that everybody has to pay. Once again, it's indiscriminate. It doesn't matter whether you're rich or poor, everybody has to pay for their electricity and their heating. And many of the 1 in 6 households that are classified as low income have built up debt because they haven't been able to keep paying these costs, and so they now owe large amounts of money to the power companies. This chart shows the movement in interest rates in the UK over the last 12 months, and as you can see, there has been a rate increase in every single month. 12 months ago, the official rate of interest was 1.5%, however today it is now at 5%. And if we expand this chart out to show what's been happening over the last 10 years, it really highlights the problem, because prior to 2022, interest rates in the UK had been running at less than 1%. And the problem that builds up in a low interest rate environment is that people get used to being able to access cheap debt, and therefore they take on lots of debt because they can afford to pay 1% interest on it. But if the interest rate on that debt isn't fixed for its lifetime, then when interest rates start rising, so does the cost of that borrowing. And if we expand this chart out again to show the position over the last 25 years, you can see that the current rates of interest in the UK haven't been seen since 2009, so 14 years ago. So basically we have a generation of workers who've come into the workforce over the last 14 years who've never experienced interest rates at this level before. And as we've discussed in previous videos, when interest rates are increased, the impact of that doesn't really feed through fully into the economy for around 6 to 9 months. Because the only people who are impacted immediately are people who want to take out new debt because they have to pay the current price. Anybody that's borrowing on a variable rate, so if you're borrowing on credit cards, that tends to be on variable rate. Some mortgages in the UK are on variable rate, and some other types of lending. However, one of the bigger issues is that a lot of corporate debt taken out by companies in the UK is on a floating basis. Medium and smaller term lending doesn't tend to be on a fixed rate, so it's floating. So when interest rates are increased, it increases the cost on a monthly basis of those loans. So when the rate of interest goes up by 0.25% in 1 month, it doesn't really have that big an impact. However, when it then goes up by another 0.25% the following month, and the following month, and the following month, and the following month, it starts to feed through, because at some point that company will start realising that it's got a lot less cash flow, and therefore will have to make decisions as to whether or not it cuts back on its workforce, cuts back on production, cuts back on buying in raw materials, and that can all have a detrimental impact on the output of that company. So that's one of the reasons why it takes 6 to 9 months to feed through. This chart shows the annual movement in the UK's GDP, or gross domestic product, over the last 3 years. And the scale on the right-hand side of this chart goes from minus 30 at the bottom to plus 30 at the top. And the line across the middle is 0. And the bars that are shown on this chart show the percentage movement for the previous 12 months for each quarter. So you can see that back in July 2020, the UK's GDP actually fell by 22.6% on an annual basis. And of course, this was in the middle of the COVID-19 pandemic, when the whole of the country had closed down. So there was virtually no production, and so we saw an enormous fall in GDP. And this was common with most other countries around the world. And the impact of the COVID-19 pandemic continued to be felt for the following 3 quarters. And it wasn't until the middle of 2021, when the UK was fully operational again, when we saw a significant bounce back in GDP and the annual figure rose by 24.4%. However, that was compared with the negative 22.6% from July 2020, so was slightly distorted. The recovery in GDP continued throughout 2021, and in the first quarter of 2022, the UK recorded growth of 10.6%. However, once again, this figure was artificially inflated by the fact that it was being compared to a previous period that was affected by COVID. In July 2022, which was around 5 months after the invasion of Ukraine by Russia started, the UK recorded GDP growth of 3.8%. In the following quarter, it fell to 2%. In the quarter after that, it fell to 0.6%. And in the most recent quarter that's been reported, GDP growth was 0.2%. So you can see from these figures that over the last 4 quarters, the UK has been recording low levels of GDP growth, and that growth has been diminishing quarter by quarter. And if you look at the trend as to what's been happening over the last 5 quarters and extrapolate forward, it indicates that GDP could potentially start to fall in the UK over the course of the next few quarters. And the official definition of a recession is when you have 2 consecutive quarters of negative GDP growth. So the UK has the potential to tiptoe into recession over the course of the next 6 months. This chart shows the movement in the exchange rate between the British pound and the US dollar over the course of the last 12 months. This time last year, 1 British pound was trading for around 1.2 US dollars. And interestingly, between June and September 2022, the British pound actually strengthened significantly against the US dollar. And by the end of September, the exchange rate was around 1.1. And the main driver for the strengthening of the pound at that time was that the Bank of England had started to increase interest rates more rapidly than the Fed was doing in the USA, which made the UK more attractive from an investment returns perspective, and therefore the currency started appreciating. However, that situation didn't last long as the Fed started to increase interest rates. And since September 2022, there has been a significant devaluation of the British pound, and the current exchange rate is around £1 to 1.27 US dollars. And the reason that that's a problem for the UK is that it's a net importer, and a lot of the goods that the UK is importing are priced in dollars in the international markets. Oil, gas, and major food substances all have a benchmark in US dollars. So when your currency starts to depreciate against the dollar, it means that the price of anything that you're buying in proportionately will be more expensive to your consumers. And that's exactly what we're seeing in the UK in terms of the high and persistent levels of inflation. And unfortunately, this can become a vicious circle, because if your economy starts to perform badly because you've got high levels of inflation which are impacting on the profitability of all of your companies, then you become less attractive to investors, so there's a lower demand for your currency, and so it can weaken further. This chart shows the movement in house prices in the United Kingdom over the course of the last 12 months. So you can see that 12 months ago, house prices were increasing year on year by 12.5%. However, since that time, we've seen month-on-month reductions in house prices as the interest rate increases have started to feed through into the market and slow things down. And the reduction in house price growth really started to pick up pace in November, when year-on-year prices had increased by 4.6%. We then saw price increases dropping to 2.1% in December, January and February. They fell to 1.6% in March, 0.1% in April, and in May 2023, house prices actually fell year-on-year by 1%. And if we expand the chart out to show the position over the last 10 years, you can see that the fall in house prices in May is the first that's been seen in the UK in 10 years. And if we expand the chart out to show the position over the last 25 years, you can see that the only other time that house prices started to fall in the UK was immediately after the global financial crisis, when prices did crash. However, they then came bouncing back, and since that point they've been rising. And one of the problems that the UK housing market is facing is that mortgages in the UK are not fixed for their lifetime. In the USA, the standard form of mortgage is fixed for its lifetime. So you may take out a 30-year mortgage with a fixed rate for the whole of that 30 years. That is not the situation in the UK. Most mortgages have an introductory fixed rate, which may be for 2 years or 5 years. And after that period ends, you then move on to a variable rate. So what that means is that you're exposed to any movements in interest rates over that period. And this chart shows the split in the type of mortgages taken out by UK house purchasers over the last 7 years. The light blue section at the bottom shows the percentage of mortgages with a fixed rate for 2 years. The section above that shows mortgages with a fixed rate of 3 or 4 years. The darker blue section in the middle shows fixed rate for 5 years. The very thin dark section above that shows mortgages fixed for more than 5 years. And the green section at the top shows mortgages with a variable rate. So what this chart shows is that the vast majority of mortgages in the UK have a fixed rate for less than 5 years. There is only a slither of mortgages that have a longer term fix. So over the course of the next 5 years, all of the people who bought houses within the last 5 years are going to start seeing those mortgage deals disappear, and they'll have to refinance at a significantly higher rate, which is obviously going to be a major problem. And this chart shows the number of fixed rate mortgages that are coming up for renewal through to the third quarter of 2024. And the colour coding on this chart relates to the percentage interest rate that those mortgages are currently paying. The light blue section at the bottom refers to mortgages with a rate of less than 2%. The darker blue section relates to mortgages between 2 and 2.5%. And the very dark blue relates to mortgages of more than 2.5%. And what this chart shows is that in the first quarter of 2023, around 350,000 people had mortgages that were maturing, so they were having to move from these very preferential rates of around 2 or 2.5% to the current market rates, which were more than double that. In the second quarter of 2023, more than 360,000 people are having to refinance. And over the course of the next 5 quarters, around 1.5 million households are coming off their fixed rate and will have to refinance at a significantly higher rate. And this chart shows the movement in average mortgage rates in the UK over the last 12 months. So you can see that back in June 2022, the average mortgage deal that you could pick up was around 4.4%. However, today it's now sitting at more than 7.4%. And if we expand this chart out to show the mortgage rates over the last 5 years, this really highlights the problem. 5 years ago, you could pick up a mortgage deal for around 4%. However, during the course of 2020 and 2021, the average mortgage rate in the UK dropped to around 2%. And as we've just seen from the data, because mortgage rates were so low and the cost of borrowing was so cheap, that drove up house prices. So we had a combination of very cheap mortgages and very expensive properties. So people borrowed as much as they could because it was cheap and easy to afford. But the problem that that's now throwing up for the UK is that as and when those 2 to 5 year fixed mortgage deals expire, everybody will now have to refinance at rates of above 7%. So that could represent an increase of 3 or 4 times the original figure that you mortgaged at. And an increase of that nature will be completely unaffordable for a lot of people. So we may see a lot of forced sellers in the market, and that could lead to a major house crash in the UK. So what's the summary and conclusion today? Well, I wanted to post this video because what's going on in the UK is a major concern. Inflation has been running at high levels over the course of the last 18 months, and that's not unusual. We've seen that in a lot of countries. And the Bank of England has been doing its best to bring that inflation back down by increasing interest rates in every single one of the last 13 months. But the problem that the UK is facing is that inflation just simply isn't coming back down. The work that the Bank of England is doing isn't having the desired impact. And the reasons for that are threefold. Firstly, the UK is a net importer, so it's having to buy in oil and food and other expensive items in the international markets. Secondly, its currency is devaluing, so the net cost of those imports, which are generally priced in US dollars, is rising, so that's putting further pressure on inflation. And thirdly, Brexit has led to an increase in the cost of all of the goods that are being imported from European countries. Previously, because of the free trade agreement, the UK was able to import things without having to pay any duties or taxes. However, now it's having to pay all of those, and so that's being passed on to consumers. So when you take a step back and look at the causes of the UK's inflation, a lot of them are external factors. These are things that are happening in the international markets. If the price of oil goes up, the UK raising its interest rates has no influence on that. If the currency value is going down, again, the UK can't really influence that. Increasing interest rates could potentially attract in more investment. However, there are a lot of factors that investors take into account, and the weakness of an economy is one of them. And as GDP growth has got down to virtually zero in the UK, it's become less attractive. And obviously, when you look at the overall impact of Brexit, the bottom line is that items coming from the European Union are now costing the UK more than they were previously. So all of this represents really bad news for the United Kingdom. And as we saw from the balance of trade figures, the UK doesn't have cash to be able to keep buying in all of these items, and so is having to increase its debt and use all of its reserves. And one of the other big implications of Brexit is the impact on the services sector. The UK does have some natural resources like oil and gas. However, over the course of the last 30 years, it had developed itself into a financial centre. It was the capital of Europe from a financial point of view. London was predominantly the first choice for a lot of financial institutions to set up their European headquarters. However, since Brexit, things have started to change, and a lot of institutions have looked to alternative options, such as Germany and France, to set up their headquarters. And the loss of this business and the subsequent income and taxes is now also starting to hurt the UK economy. So all of these factors are major causes for concern. However, one of the other big factors is what's happening in housing. There is a high percentage of owner occupation in the UK. A lot of people have put their wealth into their property. It's been a no-risk gamble for a long period of time. Prices have gone up and up and up. And apart from the relatively brief dip after the global financial crisis, this has been one of the best investments that UK consumers could make. And over the course of the last couple of years, there's been a feeding frenzy. Debt was very cheap, and everybody wanted to move out of town, to work from home, move to the coast, and prices rose dramatically. But unfortunately for a lot of those home buyers, they only fix their mortgages for 2 to 5 years. So at some point in the near future, those mortgage deals will be maturing and everybody will have to refinance at significantly higher rates. And that puts a major question mark over the UK housing market. We could see a lot of people being forced sellers, simply not being able to afford the mortgage that they put in place at 1.5% or 2% when it rises to 6 or 7 or 8%. That could drive down house prices in the UK significantly, and that would have a further detrimental impact on the UK economy because people would be worried about their net worth, they'd be worried about the value of their property, and therefore they may contract their spending, and we could see a further slowdown and GDP falling dramatically. So the overall summary of today's video is that the UK is currently in a perilous situation. It's got high rates of inflation, which are stubborn and not coming down. Interest rates are continuing to go up to try to address that inflation. However, a lot of the factors that's influencing inflation aren't in the UK's control. They are external factors. So there could be limited impact of future interest rate rises. However, if the Bank of England does persist with this policy, it's going to push up the cost of borrowing and the cost of mortgages. That could have a detrimental impact on both the spending of the UK and also the housing market. And we could see a big crash coming at some point over the course of the next 6 to 12 months. So I'll keep you posted on any further news and developments as and when they happen. Hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.